the three most important things that are happening in the world now are that we're at the end, late in a long-term debt cycle in which central banks cannot control monetary policy the same way. They can't lower interest rates. Just like in 1929 to 1932, there was a debt crisis that came as a result of an excessive amount of debt in the boom years. When they hit zero interest rates in 32, like in 2008, central bank prints money, buys financial assets. And so what happens in these cycles is that normally central banks can stimulate the economy by lowering interest rates. But when you hit zero interest rates, that doesn't work. And what they did in 1932 was the same thing they did in 2008, and that is that the central banks prints a lot of money and buys government bonds. And so we're doing that now. The important thing to know about this crisis, and that it happened in the 1930s, is that in order to get the checks that we're needing, now where will those checks come from? So there'll be checks from the government, the type of support we're going to receive. Where does all this money come from? So the government, when they say, I'm going to pay more for unemployment insurance, or I'm going to give you a loan for a small business, or so on, where do they get the money from? Well, they either tax it, but if they tax it, that's bad. So the government, they can borrow it. That's what a deficit is. The government runs a deficit. And then the question is, who's going to borrow it when everybody's financially strapped? And the Federal Reserve, they have the power to print money. So the Federal Reserve is lending the money. The important thing to know is that all that we think about money is not limited in any way, like there's a certain amount of money out there. It's all make-believe. It's all digital. So they could change the digits and then they can create money. Now that's an important consideration, because if they can create money so easily, how do we know it's going to be of value when they're creating a lot of it? That's one of the considerations that are being faced today. But the main thing to know about this is that every individual, every company, and every government has a certain amount of money that comes in the form of income, a certain amount of expenses, and then a certain amount of savings. It works the same way for everyone, so that if their income falls to be less than their expenditures, they're in trouble unless they have a good savings. And then they go to the savings. So all around the world, there are lots of entities that are in trouble in that way. So the government, the US government, want to give checks to people. If they don't give checks to people or to companies, those will go bankrupt because they may not have enough savings. So you saw J. Crew went bankrupt, just went bankrupt. And you'll see others go bankrupt because they don't have enough. And so when they go bankrupt, then that's a whole other process. So in order to prevent that, they have to give money. And so they print money. We call it print. There's not even paper much. It's digitally create money. And then that comes in the form of loans. Federal Reserve will buy government bonds. So it's a transaction of buying it. And they will also buy private bonds. They might pick a company, many companies, and they'll say, I will buy your bonds, which is the equivalent, I will lend to you. And that's what happens. And that's happened through history. So what we're going through is the same process as happened in the 1930 to 1945 period. So as I was saying, there are three important things. That is one. The second is large wealth gap. Third is that we have a rising power in the form of China emerging to compete or challenge the United States leadership. So when you have these three things together, it's a challenging mix, and it's happened repeatedly. Less effective monetary and credit system makes it, they have to print a lot of money, can threaten the value of money. Second, when you have a large wealth gap and you have an economic downturn, people are more inclined to have conflict. So how that's dealt with, we're going to reconsider how we're going to, that wealth will be divided, and that'll change taxes and relationships. And then the third is we're no longer in a world order where the United States is the only dominant power. These three things existed, and the most important things existed. And then we had the downturn in terms of the virus. So you could think of the virus like being a tsunami that came, and if it went, and if we had no more of it, it still would have left a lot of economic damage. So in all different ways, the economic damage has to be understood and dealt with. It's the same for every individual, same for every company. If you understand this, then you understand there are three things. The first is look at your income, your expenses, and your savings, and then do a stress test so that you get yourself secure. If you were to lose your income, or if the income were to fall beyond a certain level, and you play that out, maybe that means you go get unemployment insurance, or whatever. How long can you live in an acceptable lifestyle? And do you have a savings that is adequate for that? Okay, so what you do is you calculate, if I lived in a simpler lifestyle and I had this amount of earnings, how many months or years could I live acceptably? Then you look at what do you put the money in? What do you save in? I would say the important thing is those three elements: to have a plan, and maybe to have a plan with both your family. How do you get down when things got tough? And then you have to look at what happens in policy. It depends on the person. Some people would understand more about policy than other people.